All right, guys, welcome back to We Talk Money. We've got a quick pre-recorded episode for you guys this week. Summertime, vacations are here. How you guys doing? I'm here with Nikki and Travis, She Talks Finance and Stock Geek TV. What's going on, guys?
Just trying to figure out where these markets are going.
Yeah, stocks were selling off and then they're ripping back to close to all-time highs today. Bitcoin's been in a consolidation for over 60 days now. Yeah, what do you guys want to start with?
Probably Bitcoin. I mean, because that's like a lot of people are probably thinking we were at that big support level last week, and a lot of people were wondering if it was going to break down and we were going to see 20K.
Yeah.
And, today we had a little bit of a bounce off of support in Bitcoin, which I think a lot of people are like, like happy to see that. But obviously, like, we're not, by looking at the technicals, we're not out of the gate yet. It'd be nice to see this bounce really hold up with some strength and kind of retest that upper 40K boundary. But we'll see what happens. But I'm sure a lot of crypto people are happy to see what happened today.
Yeah, right now, the 30K zone kind of reminds me of, at least on the technicals and market sentiment, it reminds me of what was happening back in 2018 here at kind of the $6,000 level. I called this the line of hope because right here, even though prices were down off of the all-time highs in 2017, we went from basically $1,000 up to 20K, and we had a really fast pullback, and then we had over 6 months of consolidation around the 6K zone. And market sentiment all during this time period was still hopeful. It wasn't panic, it wasn't capitulation, it wasn't all out fear. It was a mix of, oh, well, I guess the bull market's over for now, but Bitcoin isn't dead, it's not going anywhere. It wasn't until the late part of 2018 where price broke down from 6K into the 3K zone that we had real capitulation, real fear, and real, just rage quitting and panic, right? That's when Bitcoin typically, historically, has bottomed out, when things look the most ugly, right? And so right now, to me, it still feels like we're kind of mid-range here. And also from the market sentiment side, I haven't seen the level of fear and panic and capitulation that we've seen in prior market cycles. And it's funny though, because anytime I tweet about that or mention that publicly, that, hey, I don't feel like the fear is as strong as it could be, all the people that haven't been through market cycles respond to that comment basically saying, like, what do you mean my feed is full of nothing but fear and bearishness? And I'm like, well, guess what, guys? It can get a lot uglier. I'm not saying it has to or that it's going to now, but I just don't feel that market sentiment where we're in complete despair, which is, like I said, really where things tend to bottom out.
Yeah, great point. I would say, honestly, the stock market is very much a mirror of what's happening in crypto right now. We look like we might get a nice correction there. Markets were down early in the week. Bond yields have been just going lower and lower and lower. And, people abandoning the reflation and inflation trade. People are worried, obviously, about the Delta variant. So they were selling off travel stocks earlier in the week. And then we just got a massive bounce the last 2 days. And you're back in the channel that we've been in, in the indices. And so, it's just, it's tough. It's tough to really take an aggressive stance one way or another, really, and honestly, the market still kind of looks like it has, if anything, a more, bullish stance. And so that being said, I put on hedges. I added some hedges this week. Anytime we see market volatility pick up and we're at like these all-time high valuations and we haven't had a correction in a while. And then obviously we've got the macro stuff with Delta. I get a little concerned, and I put on a little bit of protection just to give myself some peace of mind. And, that's something that, can cost you a little bit of headwind in terms of performance. But for me, it helps me sleep at night. So I don't really have a crystal ball in terms of, where I think the market's headed next. I try to look at that risk reward and the probability of where we're at and everything, and put all the pieces together. And I still just try to own like good stocks that I think over the next few years are going to do really well. So I think that's a pretty good approach. But if you're trying to time this, from a macro perspective in markets, I just believe that we're in a really tough period right now in terms of making that call and figuring out where we're going to be in 2 months.
Yeah.
Yeah.
When you look at the TA on like the S&P 500, it's really interesting because like you said, I mean, we're in this channel that we basically went into after the panic of March 2020, where COVID was just hitting, the S&P was down by a third, and then the Fed started pumping in liquidity. And then we basically in the summer of last year, so for the past year, we've been in this just kind of slow grind to the upside. And granted, we've had some head fakes, right? Like we've had a few moments where we've had some pretty big dips, at least looking historically, and eventually one of these dips is going to lead to a much deeper dip, right? All of these have just gotten bought up and the market just keeps trucking higher and making these all-time highs. That's why I say, like, it's impossible to pick tops, and shorting can be dangerous, right? Because if you're shorting mid-trend, you can get squeezed, right? But when you look at your own personal portfolio and you say, okay, here's the risks that I see in the market, here's the risks I see in the economy, you can use hedges and short a percentage of your portfolio for protection, right? You're not betting that the market's going to go down. It's just more of like a what if scenario. Is that kind of how you think of it, Trav?
Yeah. And, some people will say, well, why not just reduce exposure, et cetera. But for me, like, I don't want to sell my stocks that I really, really like, especially because it's going to generate taxes. It's potentially, some of that stuff I'm still trying to get to long-term holding periods and things like that. And so for me, I'd rather just short some indexes and put that on as a hedge. And worst case scenario, it creates a couple of percentage points of performance headwind, and I can feel the environment and out and figure out, maybe I do want to cover those at some point. But the other option obviously is to put on no hedges and just say, we're still in this, upward trending channel. Don't try to be a cowboy and make any calls on the market. And I understand that approach too. It just makes me nervous looking at how the market is, especially certain stocks in certain areas of the market are at really, really elevated valuation levels relative to history. And, again, not to harp on it too much, but the whole Delta variant thing, I said last week, I wasn't that concerned about it. I've become a little bit more concerned about it just in the past week, watching the rapid rise in cases here in North America. To be fair, I didn't expect cases. I thought we had reached at least a high enough level of vaccination and the number of people who have had it in the past year that we wouldn't see a third wave spike that went above where we were in the last two. And now I'm not so sure. Looking at the rate of change, I'm not sure. And I don't think we're going to go into a massive countrywide shutdown again, but I do think we're already starting to see some potential economic impacts from more restrictions being put in place again and things like that. And that is coinciding with, going back to school and important shopping times as we head into the back half of the year. So, it's tough to know where all that goes. In a month, we could be like, hey, that was just a little scare and it's gone again. Or we could be like, hey, this thing is still around and still causing us to have, a headwind in the economy. And so that plus being at elevated valuations historically, not a great combination in my view.
Yeah, it's a really hard thing to figure out, like, how is Delta going to affect the economy, right? And again, I always like to say, we don't care what your political beliefs are. We don't care if you still think COVID isn't real or you think it's the worst thing and it's going to end humanity. We just look at the data, right? And we're trying to figure out what the markets are going to do based on this. And for me, after digging into the data, I see two kind of bifurcated scenarios. You have countries that have low vaccination rates and their numbers are spiking. So taking a look at Indonesia, which is really sad because we wanted to go to Bali this year. Doesn't look like that's happening because their cases are spiking, but you can also see a very clear correlation in deaths. Whereas in countries like the UK, they are having a big spike in cases, right? They're almost back to all-time highs again, but their deaths are very, very low because they do have a much, much higher vaccination rate. So I think that just goes to show, again, no matter what your political beliefs are, that vaccinations can keep an economy open, I think. Nikki, what do you think?
Yeah, I mean, I haven't looked at the at UK. The UK is a great example, and I haven't looked recently at what they're doing over there, like if they're fully open. I thought I had heard that they were pulling back a little bit on fully reopening. Um, I'd have to check on that, but I
Yeah.
think that'd be an interesting case study to not only look at what's going on in the UK, but also look at what their stock market is doing too. I haven't looked at that. Trav, have you looked at what's going on in terms of stocks in Europe,
Yeah,
specifically UK?
yeah. I mean, the UK has been, basically mirroring what we've seen in US markets over the past couple of weeks. European stock indices were basically down on the dip with European stock, or I'm sorry, US stocks in the past couple of trading sessions until yesterday and today when they bounced. So they're really just mirroring each other right now.
Okay,
European
there it is.
indices are still up year to date. They still actually are trading at a relative valuation discount. So arguably you've actually got more room to run once those economies fully get back to, full strength.
Right.
But yeah, no, I mean, there really hasn't been a major divergence in the European indices versus the US ones in recent weeks. So
It's just interesting to me how the stock market, the US stock market is just brushing the risks off. So I guess what that's telling me is maybe they are calling the bluff that we'd ever see another lockdown or ever or see more restrictions. The market expects the economy to be able to stay open to a degree. Maybe it's also a mix of if anything does happen and the poo-poo hits the fan, then the, fiscal spending is going to come and they're going to bring the bazookas again and drop, money into people's bank accounts. So it could be a mix of that. And maybe also a mix of the market feeling that the Fed is going to support the market if things do get bad again. So I don't know. I guess I've been puzzled myself with the US market. Like you said, Travis, the valuations are at elevated levels. We have not seen a deep correction in the S&P 500 or even the Nasdaq in a long time. Particularly the S&P 500 has been very strong in that upward trending channel, and it when you look at it, it's like, okay, we are due, and you would think that these risks that we're seeing, we're still not open internationally. A lot of our companies have exposure to to those international markets. You would think that we would start to kind of see the market cool off a bit, but yeah, I'm thinking maybe just a mix of calling the bluff of lockdowns, a mix of federal and fiscal and monetary policy, supporting the markets, kind of, the untouchables. I don't know. I'm a little bit flabbergasted though that the US markets are just chugging along as if everything's cool.
Yeah, it's interesting. And I think another follow-up question that people would have is, well, if the Fed's going to just keep printing to prop up the markets and people aren't worried about it, why is Bitcoin down? And my answer, because I've gotten this question so much over the past couple of weeks, is like, there's not a direct correlation to the Fed printing and Bitcoin's price, right? Bitcoin has many, many factors to what influences its price. The number one being speculation, right? Let's be honest about this. Like, it's the emotion of traders, particularly new rookies that think they're going to get rich quick, that come in and buy and panic sell this stuff. That's why it's so volatile. Sure, over a long time horizon, you can look at, CAGR's compound annual growth rates and stuff, but in the short term, just because, there's fears in the economy, that doesn't mean that Bitcoin is just going to go to the moon right away, right? There's a lot that goes into that. So I would just encourage anybody that's like thinking like, well, should I just buy Bitcoin just because the Fed's printing a lot of money today? That's one of maybe 1,000 factors that actually goes into this price. So keep that in mind.
That's a good point. Yeah. And the other thing that's been baffling me is this whole inflation story. You'd think that the market seeing inflation get worse and worse every, print we get, they'd be a little bit concerned, especially with the Fed talking about raising rates before they expected. But I don't know. Yeah, it's like nothing matters, and it's a beast. The U.S. market is a beast right now.
Yeah, I'm going to pull up from our sponsor Y charts, just taking a look at the CPI data, right? So what was the last print? 5.9%?
5.4%.
5.4%. Yeah. So, I mean, inflation fears are definitely here. We talked last week about, what did we talk about? The used car prices. Thankfully, lumber prices came down, and it still looks like they're down quite a bit. They're still actually red on the year, believe it or not. It's actually down still about almost 20% on the year, which is wild to think about that. Just big wick here in the yearly chart where we broke out from a multi-decade range. Things went crazy, and that's what happens in commodities, right? When you have a parabolic move, typically it comes back to earth because producers increase supply, which drops prices. So also, just taking a look at gold, gold's just kind of trucking along. This is a very, very slow chart. I don't even really look at a daily chart on gold. I mostly stick to the weekly and mostly the monthly. The weekly chart still holding above the 100-period moving average. Travis, you were saying bond yields are coming down. Do you want to talk about what that means and what kind of that signals to investors in the whole inflation debate?
Yeah, it's interesting, right? So like the 10-year bond yields, like that, those medium-term bond yields that we often look at for forward, a forward look at basically what the bond market is saying about inflation have just been headed down for the past couple of months. And that was in sharp contrast to what we saw at the beginning of the year when rates actually rose really quickly because the market finally figured out, hey, the economy is actually going to be recovering. Consumers are going to be spending again, and we've got some serious structural supply issues in a lot of areas, right? So, the CPI is printing 5.5, and the 10-year yield now is down to like 1.3, roughly neighborhood of 1.3% this week. So that means the difference there between the current inflation rate and the 10-year rate is pretty wide, right? I mean, if you really thought that inflation was going to be printing at above 3, 4, 5% consistently over the next few years, you wouldn't want to be invested in bonds that only yield 1.3% because your purchasing power is just declining. Even though you're earning a positive nominal yield of that 1.3%, your purchasing power is declining because everything else in the economy is going up by an average of 3, 4, 5%, right? So that's what we call real rates, is that difference between the bond yield and the inflation rate. And so right now, if you subtract that, if you take the bond yield and you subtract the inflation rate, you're getting a negative number. So we have negative real rates, and those negative real rates have actually been getting worse. They've been getting more negative as we've gone through the last month or two. Now, the real question is, well, is that just a short-term liquidity problem? Like, is that just there's just too much money sloshing around that needs to go somewhere? You've got all these negative yields in Europe and Japan, and you actually have negative nominal yields, meaning if you invest in a bond, not only are you losing purchasing power, but you're actually getting a negative rate. You buy that bond and you actually receive a negative rate over time. So some of that money has flowed into the U.S. bond market, just because of the U.S. bond market, at least it's like it's like the tallest short person, right? And so they at least still have a positive nominal yield of 1.3%. So some investors have been moving capital over. So you got this weird situation, right, where even though investors are tolerating these negative real yields, people are still piling in. And so, that's been the big conundrum, right? Is this just a technical thing with investors who are trying to find yield anywhere they can get it, even if it's at negative yields? Or is it truly that investors expect inflation to be transitory and those 5% numbers that we have now are going to come down to 1%, right? And actually you could be getting a positive long-term real yield, right? And so I still believe that there's enough structural problems in the supply chains and in things like crude oil and in things like housing that are going to persist over time. So even if we have transitory stuff like car prices that eventually normalize, or semiconductor prices that eventually normalize because supply comes back online, fitness equipment, right? All the stuff that was in shortage, even if that stuff comes back down to earth, I think you're still going to have a problem with some more longer term structural things where supply is just going to be structurally short. Like we can't build houses that fast. You can't actually put that much crude oil supply back on the market that quickly, right? So, especially in an ESG world. So that's why I continue to say on the show over and over, I still think for me, I don't want to be in bonds yielding negative real rates. I don't want to be in bonds that are yielding less than the inflation rate. And gold, I'm sorry for this long-winded answer, but gold is one of those things that tends to go up as real rates go more negative. They're negatively correlated. So you would expect gold to be a pretty good performer if we stay at very low negative interest rates. So keep that in mind. I do think gold could still have upside. I don't know that I like it as much as crypto, to be honest.
Mhm.
I have a
On a-
question,
on a
Travis.
longer term basis. Sure.
I'm wanting to know, are you surprised that gold has not bounced uh quicker and stronger with the inflation data and the real rates situation that we're seeing now? Are you surprised that it's not reacting, or do you think that that's pretty normal?
No, I am surprised. And I think it is because the market is still concerned overall that the inflation is transitory, that the Fed's not going to hit its inflation target looking out 2, 3, 4 years. And so the gold market is kind of in a show me situation. It's saying, well, show me this is going to persist. And then I think you get gold performing well. If we look forward 2 years and inflation's still printing 3, 4, or maybe even higher, I think gold finally will catch up and say this asset should trade much higher.
I guess that's how kind of everything is trading right now, like show me, quote unquote. Like
Yeah.
bonds, US stock market, gold, it's almost like it's so business as usual, as if the pandemic never happened, right? And we're still printing, lower inflation rates. That's kind of what it's feeling like. And the markets are like, well, look, show me when things change, and then maybe we'll sell these bonds, or we'll sell the stock market, or buy this gold, or whatever. I don't know. That's kind of what it's feeling like to me. Is like you said. I think that that's a really good quote to kind of describe the environment.
Yeah, and looking at gold so far, we're down about 5% on the year, where Bitcoin is still actually green, even though we've come all the way down and we've got a massive wick on the yearly candle. We're still up about 10%. So it seems to be, at least as of today, and it could probably change tomorrow, next week, or in the next 10 minutes, but it seems to be that Bitcoin is holding up better than gold. But again, Bitcoin is extremely volatile, and it doesn't always immediately respond to global macro events. It takes time. So what you want to do is extend your horizon when you're looking at inflation hedges like gold, like Bitcoin, even like real estate.
You know what I find interesting? I find interesting that the US stock market and Bitcoin were both, I tweeted the chart, the side by side, but they were both testing key support levels at the same time. And they both bounced together.
Interesting.
I just find that interesting. Like, what's going on? Are people like looking are people like looking at their portfolios and thinking about how they're investing, both of them at the same time? And I don't know. I just found that very strange.
I think there may be something to that. In past years, we had run the data and showed actually that Bitcoin in a number of different periods was slightly negatively correlated to stocks, which was a very, very good thing for the crypto asset class. But we have seen lately that it's become more correlated with the market. I think a lot of that has to do with, hot money inflows, retail money. Obviously pandemic savings rate went up. A lot of that went into markets. And so I think those markets, I haven't crunched the data on the last few months. We'll go and do that this week. But my guess is we'll see higher correlations this year as opposed to past years between stocks and Bitcoin. I hope that correlation breaks again at some point. You'd love for Bitcoin and other crypto assets to be less correlated to all these other traditional asset classes because, it's hard to find uncorrelated assets. when you can find them, having them both in a portfolio together is a really, really nice property, because you can have parts of your portfolio going up when the other parts are going down. And so you can have a really nice smooth growth curve if you have uncorrelated assets together that, are both good assets. So I'd love to see it turn back the other way, but for right now, we may be in that period where all financial markets are fairly highly correlated.
So I'm wondering if Bitcoin breaks down, if we're going to see the S&P finally break down, or vice versa. To be determined.
To be determined. We'll keep our eye on it. Okay, let's go ahead and jump into earnings season. So I think we're just kind of smack dab in the middle of it right now, right?
Yeah, we're still on the front end of it. This is really the second major week of earnings. It'll go on for another couple of probably 2-3 weeks or so. Had some big companies report this week already, like Netflix, United Airlines, Chipotle, Coca-Cola, Johnson & Johnson. You can see some of those there on the screen. And got some big ones obviously still to come this week: Snapchat, Twitter, Intel, et cetera. But then next week, you also get some of the big tech companies reporting, which are heavyweights in the indices. So Apple, Amazon, Google, Microsoft, those will start to report. Yep, Facebook.
Yeah.
We'll start to get those next week. And that is going to be another pivotal set of reports. And, could also determine the direction of the way the market heads in the medium term.
Yep. Awesome. In other news, there was a talk this week about Bitcoin called the B word, where we basically had Elon, Kathy Wood, and Jack Dorsey that were giving their opinions about Bitcoin and the future of Bitcoin. We'll link it up in the show notes. I don't want to go into this too deeply. I mean, it was basically, I found this kind of synopsis of what they talked about. They talked about their kind of origin story, how they got into Bitcoin or how they first started looking into it. And then they talked about some of their concerns, what kind of role it can play in the world, what their hopes are for the future. I didn't have any massive takeaways here other than that they're bullish on it. Elon admitted he owns it personally and owns it in Tesla, obviously. I think it kind of felt to me like maybe he's trying to get his graces back in the Bitcoin community a little bit. I don't know. But yeah, I don't know. I think it's interesting that the richest people in the world and some of the most influential investors and entrepreneurs are just continuing to talk about it. Also, on kind of the government side, I tweeted this the other day where was it the EU said that someone in the EU government structure is trying to propose that they KYC basically all crypto transactions. I'm not surprised at this. I think this is going to be an ongoing battle where the bigger Bitcoin becomes, the more governments are going to try to get a stranglehold on it. And this is why I just encourage every person, no matter how big or small your crypto holdings are, or big or small your following is, to push back hard against this shit. And that's what it is. It's just really bad cronyism from government officials that are afraid of Bitcoin taking over the power structure in the global monetary system. I mean, not surprising, age where they fight you now, right? Some governments are being explicit and very aggressive. Others are pretending to be friendly while trying to subvert its eventual success. But anytime something like this pops up, share it, talk about it, push back on it hard.
Do you think that DeFi will play a pivotal role here in helping to push back? I mean, because I could imagine, some governments are going to be successful at actually implementing regulations that, I mean, we've already seen in China, obviously, they've been effective in some sense, but, governments that want to shut down on-ramps, or governments that want to shut down centralized exchanges or force centralized exchanges to KYC every single transaction, things like that. Does DeFi help to fight against that?
Yeah, I think so.
Yeah.
I think it offers an alternative route, right? There's going to be two routes. One is centralized, one is completely decentralized. And I don't think it's one or the other. I think they can both work. I think as time goes on, things are going to become more decentralized. right? Like it's not good that we have to rely on the Coinbases of the world and the Binances of the world to handle most of the trading volume. And, we've seen it with Uniswap and some of the others. And the more that some of these DeFi projects grow and evolve, and the biggest hurdle right now is governance, right? Like admin key risk and things like that. I've talked about this at length about how a lot of the stuff that is called DeFi, decentralized finance, really isn't. It's just marketing bullshit on centralized companies or decentralized organizations, right? That are from anonymous people, but they can rug pull, right? Like a lot of those kind of technical issues have to get fixed before DeFi can continue to grow in a meaningful way. I think we've kind of hit a crossroads there where, we know what works, we know what doesn't work, and there's just a lot of problems to be fixed. So it's not going to happen overnight. But yeah, I mean, there's already ways for people that are living in under repressive regimes to be able to get away the centralized control of cryptocurrency. And DeFi does play a big part of that. But again, it's not going to happen overnight, and governments aren't going to just let Bitcoin take over without a fight, right? So I don't know. I think we're living in the most interesting time in recent human history because we are literally changing what money means. And when you think about the implications of that, it's massive. It changes everything. So I know, long-winded answer, but another thing I wanted to talk about is kind of like in this choppy time where price action is kind of sideways. And, one thing that I've seen a lot of people make mistakes of doing is over trading, right? So I saw this on Reddit. It was, says happiness chemicals and how to hack them. And there's basically 4 categories, right? Excuse me. You've got dopamine, you've got oxytocin, you've got endorphins and serotonin, right? And it talks about some of the things that like trigger these happiness chemicals. And I said, notice how obsessing over price charts and trying to catch every little move is not on this list, right? So when price action is slow and choppy, do some of these other things to keep your mind happy and engaged and moving forward, right? If you find yourself sitting there obsessing over every little price move in Bitcoin or altcoins or, a stock or just the broad markets or whatever, stop doing that. Step away, right? Set up a trading plan where you're like, okay, under what circumstances should I take action? And then ignore the price action from, ignore the noise from price action and the noise of social media. Right now, I've been seeing a lot of people in crypto Twitter that are like shaming people for not being aggressive dip buyers, or they're shaming people for taking some profit, right? Turn all that crap off. Get away from it. Doesn't matter what anybody else does. It's your portfolio. It's your trading plan. It's your risk tolerance. So ignore everything, right? And then number 2, get outside. Connect with people in real life, learn something new, et cetera, right? Look at this. Like, get out in the sun, exercise. I'm trying to lose my COVID weight. I know some of you guys called me out for being fat in the last episode. I know I'm fat right now. I'm getting back in shape. You watch.
Oh.
So this is I'm also like speaking to myself here, right? We're going on a trip tomorrow, right? We're like, these are the things we need to do, obviously during the summer, but even more importantly when things are slow in the markets. That's just how I think about it. There's a season for taking a whole lot of action and pushing really hard, and there's a season for sitting back, relaxing, researching, catching up on projects that you put off when the markets are crazy. I don't know, I just kind of wanted to talk about that and ask Nikki and Travis, what do you guys think? What do you think about to try to keep yourself from over trading or, over managing positions?
Yeah, that's a great question. This is definitely one of the largest mistakes do-it-yourself investors make, is over trading. They get bored. They feel like in order to make money, they always have to be doing something in the markets. And that is literally so far from the truth. It's not even funny. The way to make money in the markets is, like you said, have a plan and think about your risk. Make sure you accept that risk, and then let that plan work. Give it that time. And you have to really sometimes it takes just going through those losses and blowing out that account to realize, oh, I'm over trading. I need to stop doing this. I need to switch up my strategy. But hopefully people watching, they can maybe learn that this is something to tackle before they blow up an account or, do something like that. So I just think that was a great little segment that I think is really important while the markets are kind of boring. Use that time to do something productive that's maybe not money related. There are so many other things in our lives, families and our health and our mental health and physical health. And so I think that you have to tend to those things, because if that's all out of whack, you're not going to be mentally there when it does come time to make that good trading decision.
Yeah. And also don't lose focus, right? Like just because the markets are slow doesn't mean you need to walk away from them. Like I still have a daily routine for where I check the markets, I look for new opportunities, and I manage open opportunity or open trades. But 9 out of 10 days, the answer to this question, is there any action required? The answer to that is 9 out of 10 of the
Usually
time,
no.
no. Yeah. Trav, what about you, man?
Yeah, I mean, I think that is pretty spot on. And for me, it's the same way. Every day or pretty much every day, I'm involved in markets. I'm researching, I'm reading in research pieces, I'm looking at macro data, I'm digging into earnings reports, I'm trying to stay up on what's happening with the companies in my portfolio, looking for new ideas, looking for anomalies in the market, right? But the actual days that I take action are, maybe once every couple of weeks, I'll initiate a new position or I'll take action on an existing position. Now, that being said, there are times like, during March, April 2020, where it was just like every day I was making trades.
Yeah.
But for
That
the
was a
most part,
crazy time.
oh, it was absolutely insane. I mean, the sleep schedule definitely suffered, but that's like why you said sometimes you got to catch up on your self-care stuff and your fitness and all that once things do calm down, because you got to be ready for those types of rapid fire environments. Yeah, I mean, honestly, talking about this kind of makes me think maybe I'm over trading right now. I'm thinking about like the index hedges I'm putting on because I got, a little bit worried about the overall market. And so, maybe I'm paying too much attention to the daily macro, right? And when I look at the most money I've made across, some of my best positions ever over the past 10 or 15, 20 years, it's almost always been in stuff that I just sat in and held through like, multiple year periods. And there were drawdowns during those periods, but I just sort of waited it out because I knew the longer term story was still playing out, and all the short term headlines, the analyst downgrades, right? The stuff that doesn't really matter, the market movements, was all just noise in the end.
Yeah.
And so
Good point.
that is a really important thing, I think, especially if you're a longer term focused investor, to think about is like, am I letting noise spook me out of my position that, is going to hurt my longer term P&L?
Yeah.
And
So on a longer term basis, it sounds like the bigger problem can be, over managing open positions, right? Where like for shorter term traders, I guess the bigger problem can be over trading on entries, right? Or like being too active when really the best thing to do is like sit on your
Sit
hands.
on hands. Yeah.
Yeah.
Yep.
I'm seeing some interesting, stuff happening in SPACs, for instance, and some of the growth stocks that were super hot in the spring, where you can see the retail money is flowing out. They're getting impatient. A lot of the pre-deal SPACs have now traded below $10 a share, meaning you're basically at no downside levels because you can always redeem your money for 10 and change on most SPACs, even if you don't like the deal. So all these SPACs that were hot trading at 20, 30% premiums in the spring are now actually trading below net asset value. Very, very interesting to see that. Now I think you actually have opportunities opening up there where you can go against what the herd is doing. So that would be an area just specifically to kind of like mention that relates to exactly what we're talking about.
Yeah, we've also seen that in Bitcoin and some of the on-chain data recently, which is coins leaving the wallets of smaller, newer wallets, right? More retail, kind of get rich quick people. That capital is flowing to longer term hodlers and larger balance wallets. So it's the same story that's been told since the beginning of markets, which is the capital flows to the patient, disciplined investor and away from the impatient, over hyperactive trader, right?
It's
So,
exhausting anyway. Trading like that is exhausting. I mean,
yeah,
if that's you and you're finding yourself having a lot of losses right now, you know, take a step back and look at where we are in the markets. Is the market you're trading flat? Is the market you're trading a lot of choppy range? You know, that's what I like to tell people to do, is to actually look at the environment of the price action that you're trading and having these losses in. If you know, the slow grinding markets can be tough. Flat markets, choppy markets, you know, you got to know what environment you're in. And Bitcoin specifically, I mean, there's like no range right now, so anyone trying to overtrade that, I would imagine, is getting chopped out, if I had to guess.
yeah,
I've got a
yeah.
new
That's
stock position that actually benefits from everyone else over trading.
what's that one?
Well, we alerted it in the community this past week.
Oh yeah.
I'll leave that one for another time, but it's actually one that benefits from, you know, retail trading volumes and more active trading and volatility in the market. So I'll leave that one for another time to chat about. But it just popped in my head that you know, we could actually make some money on this environment and this trend of people being too active.
Yeah. So talking about over trading and maybe like exchange type opportunities. So Coinbase is actually starting to kind of base out here.
Yeah.
So we've got an accumulation range. So I'm kind of keeping my eye on this $250 mark. You know, again, for anybody that doesn't know, Coinbase is one that listed. There was a lot of hype, kind of a busted IPO. I don't know, Trav, would you call this a busted IPO?
Uh, I wouldn't yet. I think it's getting to that point. But I don't believe it's actually broken below the level that, well, no, it was a direct listing. So it is, I guess, down
Yeah.
from the day one price. So I guess you could characterize it as a busted IPO technically, but,
Yeah.
you know, it is a direct listing, so it's a little bit different. But yeah, I mean, I think if this thing's down 30 to 50% from day one, then, you know, it starts to get a lot more interesting, right? We love
Yeah.
hunting in those broken IPO grounds. Not everyone is going to be worth, you know, buying into, but you know, with Coinbase, let's see, it's trading at like roughly a $58 billion market cap using the fully diluted share count. I think I said that I would start to get pretty interested below a $50 billion market cap. I'd have to dig in. We do have some longer term concerns about the competitive environment. You know, Coinbase's fee structure is very high. You've got DeFi competing at some point or at some level.
Yeah. Other
And
exchanges are really ramping up their spending and
yep,
infrastructure. And
Other
yep.
exchanges are starting to roll out commission-free crypto trading, I think. Thought I saw that somewhere.
yeah, we talked for the past few months, right, about fee compression and how that happened in stocks and futures, and it's absolutely happening in crypto right now. So yeah, I don't know. I mean, I love exchanges as a business model, but you know, kind of the first 10 years, or not quite 10 years, but Coinbase had a huge head start and they've been reaping the benefits. But yeah, I don't know. It'll be interesting to see what this chart does over the next couple of weeks and months. I'm just kind of keeping my eye on it. I might take it as a trade, maybe not a long-term investment, but if we get some kind of breakout or if the short interest gets crazy high, I don't know. It's definitely an interesting one with some big range.
The question, I guess, is always if you can trade crypto and you can trade Bitcoin, and if Coinbase is just going to be a highly correlated stock play on crypto, then does it just make sense to trade crypto directly, right? That's always the question. But there can be valid reasons why you might, even if you have pretty significant crypto holdings, there might be valid reasons why you might play the stock. Maybe it's in your IRA, right, or your 401k where you can't trade, where some people can't trade crypto, right? So that could be something that is an alternative in those types of accounts or something like that. So
Yeah. Yeah, that's a
I,
good point. Yeah, I mean, to me, at the end of the day, it's all about the chart, right? Like if there's a tradable chart and there's not anything on the fundamentals screaming against it, sometimes I'll trade it if it's crypto related. But yeah, we'll just have to keep our eye on it. You guys want to move on to my personal favorite subject, taxes?
Woo! I love
Okay,
it.
Nikki the nerd has
This is
something
a
to
good.
say.
This is a good thing. Come on, we like
Yes,
lower taxes.
absolutely.
Don't
I'm
we?
just kidding. I'm just
Come
kidding.
on.
Nikki is the one that will be reading the tax government websites on the weekend. For some reason, she gets a kick out of it.
IRS.gov all the time, all day, every day. No, I'm just kidding.
Whew,
No,
all right.
I just honestly, I just like sometimes the complexity of our tax system can make for a really great like problem to solve. Like it's almost like my brain loves math problems and things like that. I like figuring this stuff out, and the complexity kind of lets me do that. I guess that's what it is. But
Gotcha. Cool.
anywho,
Well, so what do we have here?
I feel like nobody's really talking about this, and I thought that it would be maybe a good thing to just bring up. A lot of states are actually reducing income taxation, state income taxation, and we're seeing not only the actual rates in some states completely decline and go lower, but we're also seeing a lot of states compress their tax tables and basically less tax brackets. So ultimately you end up paying less tax the way that they have it structured. They're just completely like removing certain tax brackets out of their system. So I think that this is not only that, but corporate tax, state corporate taxes are declining in certain states as well. I think what's going on here is states ended up becoming basically more, they were healthier in terms of they looked at the end of the year and said, wow, we did better than we thought fiscally, and they're trying to give back to the residents. And the federal aid had a little bit to do with this, with a lot of states coming out better than expected, but I think the other thing that has a lot to do with this is states are starting to compete now for people. They're competing for residents. They're competing for corporations to run their businesses in their states, because the work from home movement has completely changed this whole dynamic. People are moving to the suburbs. People are able to go anywhere, and states want those people to come to their states. So I think that this is very interesting. I think the work from home movement could end up shifting the state taxation landscape maybe even further from here, or we may see more states jump on board that haven't jumped on board. I've heard it's heard through the grapevine that North Carolina might be talking about reducing state taxation to some degree. So I don't know. I just think that no one's talking about this, and you know, in the U.S. we've got a lot of different states, a lot of different tax structures. So if you do live in one of these states, I think that's encouraging for you. And if you're looking to move to one of these states, that's, you know, something to look forward to.
What an awesome trend, Chris. You called this out a while ago, saying, you know, that we would start seeing increased competition between states and countries and cities for talent and capital.
Yep.
Yep.
I'm going to see if I can pull it up while we're talking about this, but I'm looking at this chart for you guys looking at the video. So there are 11 states that have reduced income tax rates, right? I also saw another chart on Reddit that was showing states that had negative population growth. So people were leaving, and the states with the biggest population growth, it's like the biggest losses of population were from like the Northeast and places like Ohio, Illinois, Wisconsin, and New York, and up here in the Northeast. And then obviously the states that had the biggest growth were like Texas and Florida, which, get this, have zero. This kind of makes sense, right? And yeah, Trav, as we talked about for several months, it's like not only is competition heating up on a international level between governments for talent and capital, but states, right? In the US, like people can go wherever they want. We've seen a massive influx anecdotally here in Austin of Californians and New Yorkers. It's like every other tag you see on a car is either California, New York, or even Washington, right? So people are going where they're not going to get screwed over by their local, state, and municipal governments.
What's funny is I actually believe that I heard that California and New York, they ended up increasing taxation slightly, if I'm not
Really?
mistaken. I'd have to double check if it was either they didn't move the needle or they increased it, but I know that they didn't make any changes to accommodate residents or help residents out, considering the people moving out of their states. So yeah, they're still taxing away,
Yeah.
basically.
Interesting.
Yeah. I'll see if I can pull this up. I don't think I'm going to be able to pull it up quickly.
I do wonder if New York and California's hands will get forced by the other states that are making these changes.
Yeah, here's an older chart. This one's a few months old, but yeah, you can kind of see some overlap here where, the population loss or slower growth is up here in the Northeast. But there was a better chart that I found that really, I mean, it lines up with this a lot more clearly. So yeah, if I, look, if I was a governor or a mayor of some sort, and I'm like, we have high taxes and people are getting the hell out of here, what options do you have? You either lower the tax rates and try to entice people to bring businesses there and generate taxes through another way, or you go bankrupt.
Well, you just have to give away a lot of your money.
Yeah. All right, cool. Here's another chart. Nikki, I think you wanted to bring this up. U.S. personal savings rate.
Oh yeah, so there was a tweet that went along with this that kind of triggered this conversation. Basically, there was a tweet and a chart saying that the savings spend down that we expect over the next, I think it's year or something like that. Yeah, that's it. Basically, it'll lift GDP, by 1% in 2022.
So does this mean people that have this excess savings, they're going to spend that over the next year, which is going to boost
GDP? Which we all know, like the savings rate was elevated because of the pandemic. We know that people were going to start spending down their savings and buying goods and going shopping and traveling. We knew this, right? But the point with the Y charts, personal savings rate that I wanted to make is I actually think that, and this happened, I believe, after the 2008 crisis. You'd have to go back on the date range to actually get it all in. But after the 2008 financial crisis, we noticed savings rates kind of elevated a little bit prior to, say the prior decade, right? And it kind of just slowly upticked. I think that 2020 could cause an interesting dynamic with US, with Americans and savings rates, because they're used to now having this cash in their savings accounts. I've actually anecdotally talked to a few people about this, that they had this influx of cash. They've seen, multiple commas in their bank accounts that they've never seen before, whatever it is, and many zeros that they're not used to, and they see that and they got used to it. They may change their spending behaviors, and we may end up seeing that personal savings rate kind of elevate and a little bit higher than it was prior to the pandemic. So I think that just a lesson in like saving money. Americans typically have been kind of bad at saving money. They like spending money. We're very much consumers. And, compared to countries like China, where their savings rate is really, really high, and they're big savers over there. So I think that this is going to be interesting to see where the personal savings rate ends up shaking out to, and if it's going to end up being even more elevated and staying elevated versus pre-pandemic levels.
That would be an interesting trend. Yeah, that would be definitely a departure from what we saw last decade. And, right after the housing crisis, everybody was talking about, 2009, 2010, how consumers had just built up too much debt, et cetera. And now we're kind of in the opposite position where consumer savings is at an elevated level. But, there are still a lot of people out there with, significant problem when it comes to saving, right? Not saving enough for retirement. So
Absolutely.
There's kind of a bifurcation. But Interesting to note, JP Morgan on their earnings call last week said they've seen credit and debit card spending accelerate in the past quarter to levels of almost 20% above pre-COVID levels,
Wow.
2019. So not just comparing to last year, but actually comparing current times to 2019, they've seen some pretty elevated spending. So they're increasingly confident about the economy and about consumer spending. So we may just see consumers spend down all this surplus.
I believe there was a counter stat to that though.
Yeah, there might be. There very well might be. I think it's
well,
probably too early to tell too.
I think the banks said that they definitely saw elevated spending on credit cards and whatever else. But to counter that, I believe it was like debt levels, like it was either revolving debt levels or something like that. I have to look it up. I posted it on my Instagram actually, because it was a side by side of JP Morgan said, you know, yes, people are spending, but they're healthier than they were before because their balances are lower. You know, they're paying down their spending quicker than before, or whatever that stat was.
No, that's completely right. Yeah, loan growth. So while spending has been really elevated, loan growth has been really tepid at the banks. So outside of like a few pockets like home loans, like the bank's loan growth has been severely negative. So consumers have essentially been paying down revolving debt, paying down credit card debt for the most part, and now have an excess savings rate that they haven't had. So they're not needing to take out as many loans. So interesting, right, to see that. It's what you would expect. So the real question, like you said earlier, is like, where does it intersect? Like, do they just spend it down in aggregate over time and we get back to the same place we were at, pre-pandemic, or do we get to some new healthy level of consumer savings that sticks at a more elevated level than what we saw in the past couple of decades? So I guess that's a key question.
Yeah, I did confirm it was
it's interesting to see
levels.
We're looking at a chart here of credit card levels, and interesting to see how debt levels have actually come down pretty significantly, really, since the first part of 2020. So
can we keep it?
Yeah, we'll see.
Can we hang on to a healthy consumer?
People are out spending, that's for sure.
I wonder if the buy now, pay later companies are also a kind of a structural change in the way that consumers will pay for, large items. Like when you can finance a Peloton on Affirm, a $2,500 bike, but you can pay it off at 0% interest over, 12 or 24 months. If that also reduces the need for credit cards at 20% interest, right?
That's a good point.
I kind of wonder about that. It may be too small to matter in the grand scheme, but it's something I've been thinking about. The buy now, pay later space is interesting, and you've seen heated competition in that space. So we've actually got a stock play. What's that?
Affirm.
Are there any publicly traded companies that?
You've got Afterpay in Australia, Affirm, Catapult. I believe there may be one other that's public in the US as well.
Afterpay.
Yep, Afterpay in Australia. They were one of the first ones public, and then Affirm went public in the past year in the US, and then Catapult just went public via SPAC, trading at a pretty big discount from a valuation perspective, Catapult that is, and to its peers. So that one's looking kind of maybe potentially like an interesting play, although they do service a subsegment of the market with like less prime customers. So if you don't get approved by a firm, they essentially kick you over to Catapult, who is willing to service, a little bit lower credit score customers and things like that. But
so Affirm is the largest player in the U.S.
I believe so, depending on how you define it.
But it looks like a busted IPO chart here. What happened?
A lot of them look like that.
Yeah.
I mean, came public at a very, very high valuation. One of those that got, pretty early, nice pop too, and has come down with a lot of the growth stocks and a lot of the recent IPOs, still trading actually at a pretty healthy valuation. And the question is too, a lot of investors have started to ask the question because you've had Apple enter the buy now, pay later space. You've had some other companies.
American Express.
That's right. So the question is buy now, pay later, is it just a feature, or is it something you can build an entire valuable company around for many, many decades? And the funny thing about this whole discussion is that buy now, pay later really isn't a new concept. You had installment loans and layaway at retailers like
Oh yeah.
decades ago.
Yeah.
Yeah.
I've
but-
thought that, Travis, for since when a firm came to the market. My thought process was just that. Like, this feels like just a feature that other companies that are already in the business, like American Express, can come in and just disrupt the hell out of them. Or
Yeah.
what's to say retailers can't somehow come up with their own system too, like Kmart had layaway. You know what I mean? It's like I thought that from the beginning, that these companies are going to have a lot to prove to not get their lunch eaten by the big guys.
Yeah. What's the cheap furniture company that does all that?
Is it Cons or is it, there's a few out there. Aaron's, Cons, there's
No. The biggest one, the biggest big
Rent-A-Center?
Nope. Oh my God.
Is it
It's
buy
like
here-
huh?
Is it the rent, or is it like buy here?
No. It's like you can buy it, but they finance it's like 0% for like 5 years. No, I'm exaggerating, but it's like 12 or 24 months, 0% financing. Oh my God, it's like the biggest, most well-known. They spend a ton of money on advertising.
Do they have a jingle? Do they have a jingle?
It will come to you as soon as we end the
Get off the
stream.
show. Yeah.
As soon as we end the show, it'll come to you. That's how it
Let's
works.
do this. Let's jump into some Q&A and then I'll remember.
Cool.
Can I ask my question first,
Yes.
or should I ask it last?
Go for it.
Okay, my question's for Travis.
Uh-oh.
Trav,
Yes.
what are the first 3 metrics that you look at when it comes to looking at a new stock to invest in? And I am stealing this question from Brian Feroldi, by the way.
That's a
What
good
are
one.
your top 3 metrics? I'm altering it by I want your top 3.
Okay. Well, it depends also on how you define a metric. Like, is market cap a metric?
Yeah, like don't overthink it. Just the 3 things that you look at first.
Okay. Definitely look at market cap. Definitely that's just to help understand the size of the company, because the share price tells you nothing, right? So you want to get a sense of, well, what's the fully diluted market cap? What kind of size company am we talking about? I will typically look at the last couple of years of revenue growth rates. Is this company growing or shrinking or just putting along? And then I'll look at either like operating profit or operating profit margins to just figure out, is this a profitable business? How profitable? I wish I had more metrics, because it's honestly like I would go into like operating cash flows, gross margins. Those would probably be the next ones.
So I think that's a great start. I mean,
Yeah.
my
let's
top
recap.
3.
What are the top 3?
Yeah, recap.
Market cap, revenue growth rates, and I'll say operating profit margins.
Okay.
Gotcha. So how big is the company? What's it valued at now? Right. And then how fast are they growing revenues?
Mm-hmm.
And then what are their margins? How much are they actually keeping?
Yeah. Is this a structurally profitable business? How profitable? That's basically what it tells you.
These were my top 3. Tell me if my ordering could be improved, but this is just how I do it. I look at revenue growth first. I want to see like how fast or slow it's growing for me to even go further. I look at how much cash they're burning or not burning, basically like their cash flow. And then I compare their either enterprise value to sales or price to sales to competitors. That's like my flow.
I love that. Yeah. I mean, I would definitely say those are top 5, top 10. The valuation metrics would always come next for me. Like, what is this trade, EV to sales, or is it, market cap to free cash flow, price to earnings, right? These are going to be like the very next thing I'd probably look at. So I like that you included one of the valuation multiples as one of your top 3.
Okay, cool. I'm on the right track.
Sweet.
I think net debt is also a big one. I often look at a balance sheet pretty early in the process. I want to know if a company's got like the ability to go to 0. Like, is it leveraged? That's always a big.
That was going to be my 4th, but I tried to keep it to 3. But 4th would have been the debt.
Yeah.
Okay.
Great question. Next question is actually for Nikki from Susan. What is the best way to leave my assets to my children, especially my 2 houses?
Great question. So, quick lesson in estate planning. When you pass and you have assets, it can go one of a few ways. If you do not have a will, or if you do not have a trust, a living trust, then, and you do not have a beneficiary set on your assets, meaning your brokerage accounts, real estate's a bit different. If you do not have that set, then your assets will go through probate. And probate is basically a long process of the courts deciding where your assets go. It's public, it's not fun, and it's expensive. So if you do not have proper estate planning in place, that's what happens. If you have assets that you can set a beneficiary like brokerage accounts, bank accounts. You can set a payable on death beneficiary. This trumps everything. If you've got a beneficiary in there, it's going to pass like that, even if your will says something different. The other thing that you can consider doing, which I would highly suggest, especially if you have real estate, is doing a living trust, so that you avoid probate completely. If you have a living trust, they basically, an attorney, an estate attorney can draft one of these for you. You will put in there exactly how you want your assets to pass. You bypass probate completely as long as all of your assets are in that trust. So you may have to retitle some assets to get the trust, to get the assets in that trust, but it's worth it to avoid the issue of probate and not, making sure that your assets pass exactly how you want them to pass. And, there's more than just that with with getting estate planning done. There's also things like healthcare directives, powers of attorney, that if you end up not being able to take care of your affairs because you're incapacitated, these are all things that we don't really like to think about, and we don't think are going to happen to us, but you never know. And if it does happen, you don't want your loved ones scrambling to try to figure out and fighting with banks and fighting with, hospitals to try to get things done. So I would say set beneficiaries first and foremost. You can do that today. You can go on certain accounts and set that today, and then work on getting a living trust so that your assets pass and avoid that probate process.
Great answer. Awesome. I actually am going to take a question that we've gotten in multiple forms and propose it to Travis. We've talked a lot about meme stocks over the past year or so, and we've gotten so many questions about, what do you think about the MOAS, the mother of all short squeezes that could still happen on GME and AMC and a lot of the meme stocks, and all of the stuff around fraudulent shares and the controversies around, Citadel and all that. And maybe this is a topic that's going to require much more time and maybe pulling up different articles and things that people have researched. But Travis, do you have any opinions or any like high level things that we could like say to somebody who's like, what do you think? Is GME going to 1,000? Is Citadel doing evil stuff? What is this whole situation that has gotten so much controversy and so much buzz on Reddit and FinTwit and all that stuff?
Great question. Yeah, I think we should definitely tackle it in a larger show segment, but I'll say that I think a lot of this has gotten into like conspiracy theory stage where there's a lot of fiction and not a lot of fact being put out there now. I worry because there's a lot of newer retail investors who have YOLO'd like significant portions of their capital into one or two stocks like AMC or GME. And look, we called out GME. We took GME as an opportunity when it was a single digit stock. So we're not like, we're not people that are trying to like rage against a certain company here. We own GME. We saw the potential for it to squeeze when 100% of GME's float was short, right? So I want to say a couple things about GME and AMC right now is most of what you're hearing on that, conspiracy theory stuff about it going to 1,000, there's very few examples of that ever happening to any stocks in the market is the first thing I would say. The GME squeeze actually was probably one of the most violent outside of maybe Volkswagen in 2008, where it went up 5x in one day. I think the expectations that these stocks are going to go to some, price level that is like 1,000,000% or whatever higher is kind of crazy, especially when you look at like the short interest on these stocks have come down in recent months. The float has gone up in both of those stocks. In fact, in AMC, the total shares outstanding, and we can show a chart of this on Koifin or something like that, has gone up like 5x since late last year. And so the number of available shares has ballooned. So the conditions that we saw when GME, for instance, was a single digit stock don't really exist today in GME or AMC when I just look at the numbers. When I look at things like short as a percentage of the float, when I look at the borrow rates, you can get a really easy borrow, hundreds of thousands or even several million shares available to borrow from major brokers like Interactive Brokers, E-Trade, Schwab, et cetera, on both AMC and GME at less than a 1% borrow cost. When I see that, that suggests to me that the stock borrow is not tight, that there's not really a situation, at least currently, that suggests that it's going to squeeze at some massive level in the short run. So I'm concerned about all the conspiracy theories put out there. The truth is there is naked shorting that happens in the market. Some of it's just technical. Some of it happens because a market maker needs to take the other side of a trade and hasn't fully done the borrow yet. Most retail traders and most hedge funds cannot actually borrow a stock without first locating the stock. So getting a stock borrow. Go try to do a naked short at Interactive Brokers or E-Trade or Schwab or Fidelity. You can't do it. You've got to go find the borrow first. The same is true at hedge funds. When I worked at, the two hedge funds that I worked at, we had to go through our prime brokers to locate a borrow first. There are very few hedge funds in the world that could actually short a stock without first getting a borrow from their prime broker. So, if Citadel, the market maker, wants to execute a naked short sale, it might be possible, but most hedge funds are not able to do that. And you can see also the fails to deliver statistics daily. I believe AMC is not even on the fails to deliver like threshold list anymore. So it's not a stock that's seeing a lot of naked shorts. It's not seeing a lot of failures to deliver. So those are just some things that suggest to me that a lot of this noise, a lot of the people chatting on YouTube about the mother of all short squeezes just aren't really looking at the facts and the data. But we can tackle this, obviously, like I said, in a longer segment.
Yeah, I think it would be really cool to pull up some of the most popular posts on, like Wall Street Bets and stuff like that, where there's a lot of people that have done deep dives and they're bringing up a lot of this evidence and stuff. And I think it would maybe be really educational for people to see what of that is fact, what is fiction, and what could actually impact the price and what is really just fluff, right? Because there could be shady stuff going on, but that doesn't necessarily mean it's going to cause the price to do X, right?
Yeah, that's exactly right. Yeah, there isn't a one-to-one correlation. I mean, GME was actually at like 90 to 100% short interest as a percentage of float last year for months before it squeezed. So the timing of that, I think if anyone tells you that they see a situation and they can tell you exactly what's going to happen in the stock the next day, I mean, they're probably just, giving you BS, right? They're probably just, lying to you.
Yeah. Yeah, I think that's a great point. And, I know this is a hot topic. A lot of people get really emotional about it. And there's people on both sides of the equation. But yeah, maybe we'll do in a future show like a deep dive on what all the information that's been put out there and really how to decipher what's fact from fiction.
I'll say one last thing on it, and that is, when I look for these situations in stocks, like a short interest being high is just one factor. Like it's best to build a thesis around a number of different factors that are working to your advantage as a stockholder and playing probabilities. I don't think there's ever 100% certainty in most trades unless you have like insider information or something.
Yeah.
And again, short interest is just one factor of many that could affect a stock. So I think you want to have much more than that in your investment thesis for, you to have a high probability trade in most cases.
Yep. I agree completely, man. All right, cool. Moving on. We've got another question from, I believe, Ava. Hey guys, new to the crypto world, but been learning a lot from your show. I'm considering using Binance to start with as an exchange, as Coinbase isn't available. Would you recommend that? I heard that many investors can't withdraw money because of technical issues. Is that a real risk? Any info on preferred exchanges for Hong Kong or non-US investors would be appreciated. Yeah, let me start by saying this. I don't endorse or recommend any specific exchange. There's a lot of crypto YouTubers that are out there shilling affiliate links for unregulated, highly risky, high leveraged futures exchanges or spot exchanges that offer margin in different ways. I don't endorse any of those. I would just encourage you to look at the leaderboard of where the volume is being traded, and Binance is one of the top by volume, right? So go to coinmarketcap.com or Masari and look at the top cryptos and see where the liquidity is. Where are things being traded? And then see out of the top 5 or 10 what are available in your area, and sign up and learn those platforms intimately. Learn everything from, what types of orders they have, what fees they offer, what the security profile is for your account with two-factor authentication and things like that. And then choose a few that you're probably going to have to send in your KYC, your know your customer information, and verify your identity. Um, Fortunately or unfortunately, whatever, that's the way that the world is going with centralized exchanges. And then the other side of the world is what we talked about earlier with decentralized exchanges or DEXs, where you don't need a KYC. There is no central company or counterparty risk. It's just you in the market. And then before you start making big moves, practice placing trades with very, very small amounts of money, send money between wallets, just get very familiar with how to use everything, right? It's just like any other business, right? If you're going to, I don't know, open an ice cream shop, you're going to want to learn how to use all the equipment and make sure everything functions properly before you put a big "we're open" sign and you invite people in. You know, if you expect to step into crypto on day one and make $1 million by week two, sure, you might get lucky, but more realistically is that it's going to take time for the right setups, the right opportunities to come along. So there's no rush in that, right? So invest in your own education and what I call market tuition. By even if you lose a little bit of money by placing those practice orders, it's better to learn those hard lessons with a small amount of money than YOLOing in and blowing out your account, right? So hope that helps. I think we've got one more question, then we can start to wrap it up. Wes says, I just migrated my Ally savings account, getting measly 0.5% API interest rate over to Coinbase, and basically doing yield farming to get 10% on my savings. Am I a risky dipshit, or is this the future of savings accounts? Look, there is no such thing as risk-free savings. That's the answer in the short form. The long form is if you have risk capital that you are okay having a higher risk profile on by doing some of the yield farming stuff, that's okay. But just know that it's not, FDIC insured, or it's not, backed by something other than a company's promise. There have been rug pulls, there have been exit scams. Like, your principal is at risk with these platforms. So realize that. They might be advertising 8, 9, 10% or more interest, but that is not risk free. So again, not personalized financial advice. I'm saying this in general to people. I don't think it's smart to put your emergency fund or your core savings into something like this. If you have risk capital where it's not going to affect your lifestyle if you lose that principal, and you have a higher risk appetite, then maybe you could play in that. But again, there's no such thing as risk-free interest, especially not at 10%. If there was, all the banks would compete those APYs away.
I agree. I think that a suggestion would be to take out whatever is your true core emergency savings. That money is not meant to make yield. That money is meant to stay safe and secure and liquid. So keep that money in your ally, take that 0.5%, just deal with it for that safety. And then whatever, like Chris said, you can risk. It's not, look, yeah, like you said, FDIC insurance is lacking in yield farming via Coinbase. So that's definitely something to consider. Something that I have been reading about and kind of talking about with a few people has been the taxation of doing a lot of these things like yield farming and staking and things like that, where I'm not familiar if, and Chris, may I ask, when you do yield farming, do they convert your BTC into a stable coin? Is that what they do? Or
It depends. There's so many different ways to do it. And I am definitely not even going to pretend like I can answer tax questions about some of these more.
Well, what I will say is there are a lot of things up in the air about the taxation of these activities, because we don't have a lot of guidance from the IRS, and DeFi hasn't been addressed at all. So once DeFi is addressed by the IRS, we'll know more. But for right now, everyone's kind of shooting blind and just taking the tax guidance that we have and working with that. So all I'm saying is, always consult with your tax professional, but there could be some complexities here if the rules end up changing that you need to be aware of, especially if they're taking your coins and they're converting them to a different kind of coin for you to be able to do that activity. It's questionable right now if that's a taxable event or not. We don't know. So
just keep good records, right? Like whatever you're doing, just keep track of it because you might need it in the future.
Yeah.
Awesome. Any other questions or anything that you guys wanted to cover? I know we've been going actually for quite a while. The markets are, just to recap, markets are kind of at a pause moment, right? Not a whole lot of volatility over the last 2 months in crypto. Stock market just seems to be kind of ticking higher. A lot of fear and uncertainty around the Delta variant, but the markets haven't reflected that yet. What else? I think we've answered quite a few good things and covered a lot of the good things. One thing I wanted to point out is if you guys want to join our wealth building community, I'll pull up a link here. We've gotten a lot of questions about that recently. You can just go to wetalkmoney.com/community and you'll get a bonus course, the mental mastery course, which I think is just so vital for today's market. And when we're at these kind of tipping points, a lot of people, we see this all the time. People's mental game is the number one reason why they make mistakes that cost them large amounts of money. So if your mind game isn't right, it's going to be really hard for you to perform in the markets on a consistent basis the right way. So again, if you want to join us, go to wetalkmoney.com/community and you can check out what we do and how we hang out with our group on a daily basis. And yeah, anything else you guys want to say about that?
I think you covered it. Yeah.
Cool.
Very, very cool.
All right. Well, Travis and Nikki, thanks for joining me today. For all you guys that are watching this recording or listening on the podcast, also thank you guys. Go to wetalkmoney.com if you want to submit a question for the show. Have a great summer, and we will see you next week.
Cheers.
Take care, guys.